When foreign investors establish a company in Vietnam, their attention is usually focused on growth. Sales, operations, hiring, market expansion, but one of the most dangerous risks often remains invisible in the background. Accounting compliance. Many FDI companies in Vietnam appear operational on the surface, tax filings are submitted, invoices are issued, bank transactions continue normally. But underneath, hidden accounting risks may already be developing, and in many cases, foreign investors only discover these problems when it is too late. For foreign-owned companies, accounting in Vietnam is not simply administrative bookkeeping. It is part of a broader, legal and regulatory framework. Your accounting records affect tax compliance, audit readiness, profit repatriation, labor compliance, and the company's legal position during inspections or disputes. This means accounting errors are rarely isolated issues, they often trigger wider operational and legal consequences. One of the biggest hidden risks is that foreign investors often cannot independently verify whether their accounting system is actually compliant. Many rely entirely on local accountants or external service providers. But if reporting is inaccurate, incomplete, or poorly managed, the investor may not detect the issue immediately. The company may continue operating for months or years before problems surface during tax inspections, audits, or investor due diligence. A common accounting risk for FDI companies in Vietnam is incomplete supporting documentation. Expenses may be recorded without proper invoices, contracts may not align with payment records, internal approvals may be missing. At first, these issues may seem minor, but during tax finalization or audit review, unsupported expenses can be rejected. This may increase tax exposure and create unexpected liabilities for the company. VAT compliance is another area where hidden problems frequently arise. Incorrect invoice handling, late declarations, inconsistent reporting between systems, or improper classification of transactions, these issues may not immediately attract attention. But once discrepancies are identified by tax authorities, the company may face penalties, reassessments, or increased scrutiny. For foreign investors unfamiliar with Vietnam tax procedures, these risks are often difficult to identify early. Accounting risks are also connected to employment compliance. Payroll records must align with labor contracts, insurance registrations, and tax declarations. If salary structures are inconsistent or improperly documented, this can create both tax and labor exposure. In some cases, foreign companies discover that internal HR practices were never fully aligned with accounting records. And by that stage, correcting the issue becomes much more complicated. For many FDI companies, annual audit season becomes the moment when accounting weaknesses are exposed. Auditors may request documents that cannot be produced, financial records may contain inconsistencies, or accounting entries may lack proper supporting evidence. What seemed manageable during the year suddenly becomes a major compliance issue. This creates stress, delays, and additional professional costs for the business. Many foreign investors do not realize that accounting compliance directly impacts profit repatriation from Vietnam. To legally transfer profits abroad, companies generally need compliant accounting records, completed tax obligations, and audited financial statements. If financial records are weak or inconsistent, profit transfers may be delayed or questioned. For investors expecting smooth financial operations, this often becomes an unexpected and frustrating problem. One reason these hidden risks develop is the use of low-quality accounting support. Some providers focus only on filing reports without conducting deeper compliance review, others lack experience working with FDI companies. Communication may also become a major issue if the provider cannot explain risks clearly in English. As a result, foreign investors may believe everything is under control while serious problems continue building in the background. Successful foreign investors in Vietnam do not treat accounting as a low-priority administrative task, they treat it as part of risk management. A strong accounting system helps protect the company's legal position, operational stability, and financial credibility. It also supports smoother audits, better investor confidence, and long-term scalability in the Vietnam market. At LTS Law, we understand that accounting compliance is closely connected to legal and operational risk. While we do not directly provide accounting services, we help foreign investors identify accounting and audit providers that have experience supporting FDI companies in Vietnam. We focus on providers with strong communication capability, transparent processes, ethical standards, and practical understanding of foreign investor needs. Our goal is to help clients build a stable and compliant business structure from the beginning. Hidden accounting risks often remain invisible until they become expensive problems. For foreign investors operating in Vietnam, prevention is always easier than correction. Visit lts.com.vn and book a consultation with LTS Law to learn how we help foreign-owned companies strengthen compliance and reduce operational risk in Vietnam.